Most beginners buy the wrong thing first. Not because it's bad, but because it's complicated. I made this mistake myself. When I first started investing, I wanted to feel smart. I wanted to look at my portfolio and feel like I knew what I was doing. Like I had done the research, made the right calls, and picked the right stocks. So I bought complicated things. I diversified across a dozen different investments. I read reports, watched charts, tried to time entries. And the result? I overcomplicated everything, second-guessed every decision. I performed worse than if I had just kept it simple from day one. In this video, I'll show you exactly what I would buy today if I was starting from zero, and more importantly, why that simple choice is almost always the right one for a beginner. But before we get into it, if you're new here, my name is Jonathan Allen, and for the past 9 years, I've been helping everyday people understand money in a way that actually makes sense. If you want more of that, hit the like button and subscribe right now. Every video I make comes from real experience, not theory. All right, let's get into it. Before I tell you what to buy, I want to talk about what's happening to your money right now if it's sitting in a savings account. Inflation doesn't take days off. Every single day that your money sits in a traditional bank account, earning less interest than the inflation rate, you are losing purchasing power. Not dramatically, not all at once, but slowly and consistently, the value of that money is being eaten away. $1 today buys less than $1 did 2 years ago. And if your bank is paying you 0.5% while inflation runs at 3 or 4%, the math is working against you every single month. The point of investing isn't to get rich fast. The point is to make sure your money grows at a rate that at least keeps up with, and ideally exceeds, what inflation is doing. That's the baseline. And the good news is, for a beginner, reaching that baseline is simpler than most people think. Let's talk about why simplicity wins, because this is the core lesson of everything I'm about to tell you. There's a well-documented phenomenon in behavioral finance called choice overload. The more options you have in front of you, the harder it becomes to make a good decision. And the more likely you are to either freeze completely or make an impulsive choice just to feel like you did something. The investment world is full of choices, thousands of stocks, hundreds of ETFs, dozens of asset classes, bond funds, sector funds, international funds, growth funds, dividend funds, thematic funds, the list goes on. And for a beginner sitting at a brokerage account for the first time, that menu feels overwhelming. Here's what I've learned in 9 years of working with people on their personal finances. The investors who perform best over the long term are almost never the ones who made the most sophisticated choices. They're the ones who made simple choices and stuck with them. Every additional layer of complexity you add to a portfolio is another decision point, another opportunity to panic, another variable you have to track and manage. Simple isn't a limitation. Simple is a strategy. And for most beginners, it's the best one available. So what should a beginner's first fund actually do? I want to walk you through 3 things, and I want you to measure every investment you ever consider against these 3 criteria. First, it should be diversified. This means you're not putting all your eggs in one basket. A diversified fund spreads your money across many companies, many sectors, sometimes many countries. When one company struggles, the others carry the weight. You're not betting on a single outcome. You're participating in a broad system. Second, it should be low cost. Every fund charges a fee called an expense ratio, a small percentage taken from your investment each year to cover management costs. For actively managed funds, this can be 1%, 2%, or even higher. That might sound small, but compounded over decades, high fees can cost you tens of thousands of dollars in lost returns. The fund I'm going to describe has an expense ratio as low as 0.03%, basically nothing. Third, it should require zero management. You should be able to buy it, set up a recurring contribution, and leave it alone. You shouldn't need to rebalance it, trade in and out of it, or make decisions about it every month. It should be as close to a set-it-and-forget-it investment as possible. One type of fund meets all three of these criteria better than almost anything else available to a beginner. And that's a broad market index fund tracking the total stock market or the S&P 500. Here's what a fund like this actually is, in plain language. When you buy an S&P 500 index fund, you're buying a small piece of 500 of the largest companies in the United States, all at once, in a single purchase. Companies like Apple, Microsoft, Amazon, Google, and hundreds of others. You're not betting that any one of them will succeed. You're betting that American business as a whole will be larger and more valuable in the future than it is today. That's it. That's the bet. And it's a bet that over long time horizons has historically been one of the most consistent bets available to everyday investors. Not guaranteed, investing always carries risk, but consistent in a way that very few other approaches have been. Some well-known examples of this type of fund include ones offered by major brokerages that track broad indexes. Many of them can be purchased with as little as $1. They trade like stocks. They're available on every major brokerage platform, and they require absolutely no expertise to own. Now, here's something I want to address directly, because I hear this from beginners all the time. People feel like one fund isn't enough. They feel like a serious investor should have a diverse, multi-fund portfolio. They feel like owning just one thing is somehow not legitimate, like they haven't really done the work. I want to push back on that feeling because it's wrong. One good broad market index fund already gives you exposure to hundreds of companies across dozens of sectors: technology, healthcare, finance, consumer goods, energy, and more. You are already diversified. You already own a piece of the economy. Adding more funds on top of that, especially when you're starting out, doesn't meaningfully increase your diversification. What it does is increase your complexity, increase your costs, and increase the number of decisions you have to make. You don't need 10 investments to feel like a real investor. You need one good investment and the discipline to leave it alone. That combination, practiced consistently over time, is what actually builds wealth. Now, I know the next question. Where exactly do I go and how do I actually do this? That's exactly why I put together a step-by-step guide for beginners that walks you through the whole process from scratch. In that guide, I cover 24 alternatives to keeping your money in a traditional savings account. Options that give your money a real chance to grow, and most of them you can start with as little as $100. The link is in the description below. If you're ready to take your first real step, that's exactly where to go. It's clear, beginner-focused, and built to give you direction without overwhelming you. Here's what I want you to take away from this video. Simple beats smart when you're starting out. Not forever. As your knowledge grows, your strategy can grow too. But at the beginning, the most important thing is not to pick the perfect investment. The most important thing is to start, to stay consistent, and to not let complexity talk you out of doing anything at all. A broad market index fund is diversified, low cost, and requires no management. It beats the majority of professional fund managers over the long term, and it lets you stop overthinking and start building. If you want investing explained simply, calmly, and without the noise, subscribe to this channel. 9 years of experience, delivered in a way that works for real people starting from zero. And I want to hear from you. Drop a comment below and tell me, have you already bought your first index fund, or are you still figuring out where to start? What's the thing that's been holding you back? I read every comment and respond to as many as I can. Let's figure this out together. Thanks for watching. I'm Jonathan Allen, and I'll see you in the next one.